Fitch's Fixed Interest podcast delivers the analyst insights and updates you need to stay ahead in a rapidly evolving market. From global macroeconomic trends to sovereign credit developments to regulatory and political changes.
Welcome to Fixed Interests. My name is Sarah Repucci, your host for today's discussion, and I'm pleased to be joined by Justin Patrie, head of Fitch's credit commentary and research team. Justin is author of our semi-annual Global Credit Outlook and our quarterly Global Risk Outlook, and he's here to discuss the global credit environment. Welcome, Justin.
Thank you, Sarah. Great to be here.
I think we hit the ground running in 2026, and there's been some rapid geopolitical and policy developments. So I'm wondering, what is Fitch's outlook for the global credit environment this year?
Sure. Let me just take a step back and say, where does our global credit outlook come from? And it's really this really big exercise where our analysts and our strategists get involved with at the end of every year, where we look at our top-down forecasts, our bottom-up issuer analysis, and we come together to form a global credit outlook picture that includes outlook indicators for over 300 sectors that we cover. We publish over 100 outlook reports as well. And so when all of that comes together, we kind of try to form a kind of a distilled view for global credit. And if I had to sum up the global credit outlook in 2026 into kind of one or two words, it's really resilience, or perhaps benign. These are words that came up quite a bit in a bunch of our outlook reports. And essentially what we're seeing is, of those 300 sector outlooks, which kind of measure the relative direction of credit conditions for that sector in particular, of those 300, 70% we are expecting kind of neutral credit outlook, which means that we generally expect the credit conditions or the asset performance in the case of structured finance sectors to remain broadly the same in 2026 as we expect in 2025. That's also backed by our rating outlooks. So our rating outlooks are kind of the relative kind of direction or bias of an individual issuer rating over the coming 2 years. And if you look at our rating outlooks, our positive outlooks and our negative outlooks and our stable outlooks, the majority are stable. But of the remaining that aren't stable, that are positive or negative, if you take the positive and you net out the negative, it is net zero for both investment grade and sub-investment grade ratings at the global portfolio level. So and it's been that way actually for a couple of years. So our rating outlooks are signaling that generally we expect stable ratings trajectory at the global portfolio level in the year ahead. And our sector outlooks as well, on the whole, are suggesting that we're not expecting that much change in the year ahead. And that's despite some of the kind of really headline, shaking risks, whether that's geopolitical risks or policy changes, tariffs, macroeconomic trends. If you still look at everything, generally the conditions heading into 2026, according to our base case, at the global portfolio level, are roughly neutral.
Okay, so these neutral sector outlooks predominate, and positive factors are generally supporting the credit environment. But what are those pockets that are places where we see greater credit pressure?
Yeah, so you heard me caveat several times there: global portfolio, and just netting positive and negative outlook. So if you start to distill, kind of a layer down where you start to look at individual sectors or regions, that is where you start to see some potential challenges in some certain areas. And that's where the outlook picture starts to become a little bit more sophisticated, a little bit more complicated than simply benign and resilient. And certainly in 2025 even, there were some notable rating actions and changes at the sovereign level in Europe and in Asia as well. So there can be quite a bit of volatility underneath the kind of the headline global picture. And so our outlook analysis, heading into 2026, kind of outlined kind of four major themes, cross-sector themes. There's some idiosyncratic sector themes that are worth highlighting, but kind of four themes that popped out to me when I was drafting the global credit outlook, kind of cross-sector sector outlook theme. So one is China. So China's heading into its fifth year of its housing market contraction. So that persistent housing weakness, and the contraction in fixed capital investment that we started to see last year, that's kind of a theme that's showing up. So a number of sectors related to Chinese real estate, fixed capital investment, those sorts of things are on what we would call a deteriorating outlook, where we actually expect conditions to worsen. The second one is U.S. consumer pressures. And you might have heard this term, the K-shaped consumer or the K-shaped economy. And we started to see that in the U.S., where consumer spending as a whole has remained, almost surprisingly resilient, kind of beaten expectations on the upside. But the subprime or the lower income consumer, we are starting to see weakness there. So while headline kind of consumer sector expectations for the U.S. consumer are generally neutral or we expect no change. We see some asset performance outlooks on the structured finance side for the lower income consumers where we expect some deterioration. The third item is global trade, U.S. tariffs. That remains a persistent theme. So there are some sectors like global shipping or global autos or chemicals, sectors that are deeply integrated in a global supply chain where we have a deteriorating outlook. And the fourth theme is Canada. So a number of our Canadian sectors, we expect deteriorating conditions. Mainly because of the trade uncertainty and the macro uncertainty. So Canada, we're not expecting a recession, but growth is forecasted to decelerate. And Canada just has this outsized exposure to U.S. trade that makes it more vulnerable. And if you look at our outlook analysis for Canadian sectors, that trade uncertainty kind of comes up persistently. Even if, on the whole, we don't expect major ratings downgrades in Canada, certainly the credit conditions aren't going to be very helpful.
Okay, so that's still part of our base case for those sectors that you mentioned, but obviously there's significant policy and macro uncertainties that pose risk to this base case. And you touched on this a little bit, but I'm wondering if you could tell us a little bit more about things that market participants should look out for.
Yeah, so it's important to remember that our sector outlooks and our rating outlooks, these are predicated on our base case forecasts and assumptions. But of course, there's always risks, the risks to outlook or uncertainties, however you want to frame it. And so, in addition to these areas where we are seeing pressure, there are kind of 5 key what to watch items, as I would call it. These aren't exclusive, comprehensive. There are certainly other things to watch, but I had to distill it to a certain number at some point. So, these 5 key risks or what to watch items that we flagged is first is kind of market and asset price risk. So, the strength of capital markets in 2025 was very important for credit. It was very important for the economy and consumption as well. So we had a strong wealth effect from the strength in equities market that's bolstering the U.S. consumer. I mentioned the consumer before. We also had very kind of strong funding and liquidity conditions that helped refinancing and credit. But if we essentially see those market conditions start to rupture, or there's any number of potential catalysts that could lead to a market shock, we saw a bit of rumblings of that in April last year. That would undermine a lot of our assumptions. The second is that sustainability of U.S. consumer resilience. So what happens if the lower income pressures, the pressures on the lower income categories start to spread? And again, one of those catalysts could be a market shock, which affects a wider range of consumer sectors. The third is Chinese investment, kind of general Chinese macro conditions. So the contraction in Chinese investment that I mentioned in late last year, that's something worth noting. So if that doesn't recover as strongly as we expect, then that starts to affect our base case assumptions. The fourth is U.S. tariff volatility. So that's something that certainly January reinforced, where there were a variety of policy events, shall we say, or foreign policy events where more tariffs got threatened on key trading partners of the U.S. That's going to matter. The USMCA trade agreement with Canada and Mexico, that's coming up. That will provide a focal point for uncertainty, especially for Canada and Mexico, but also the U.S. And finally, I think the fifth uncertainty, again underscored by what we saw in January, is geopolitical risk. So geopolitical risk is always hard to define explicitly, but we certainly have hotspots. We saw them in Venezuela. We have them in the Middle East, in Asia, Europe in parts. And we also have just generally an elevation of kind of geopolitical uncertainty, which is contributing to major trends such as increased defense expenditures. So that's kind of the fifth one to watch there.
All right. With all of this in mind, I want to zero in on some what to watch items. So I'm going to give you some quick fire questions. All right. First one. What is one leading indicator to look out for in the first half of the year?
Sure. There's always a lot. I think everyone has their favorite. I don't know if people have favorites, but I will say one forward-looking indicator that I think is especially important for people who follow our research is sub-investment grade rating outlooks. So I did mention at the top that our net rating outlooks at the global portfolio level have remained roughly flat for the past couple of years at net zero. We have started to see a kind of a slight deterioration that's gone on for several quarters in sub-investment grade category. So these are kind of forward-looking indicators of where we expect ratings trends to potentially go. And so the sub-investment grade tends to be more sensitive to events and unexpected risk events. So I think that's something I would watch. And if that deterioration continues, then that's noting something in terms of our rating expectations.
Absolutely. All right. One consensus view that you are most skeptical of.
Sure. I don't know if it's a consensus view, but I think I think the idea that this time is different kind of mentality when it comes to AI. So I don't think there's any question that AI is likely to be a transformational technology in terms of productivity and business disruption. But the scale of AI investment, this is another thing to watch in terms of just because a technology is transformational doesn't necessarily mean that the investment case can't be overblown or valuations overblown. And so this is certainly something that, one of those kind of market asset price risk scenarios where what if the long run revenue and profitability potential of these AI related companies is reassessed, and that translates into kind of valuation changes in markets. So